Perfect. It's 9 o'clock. Amelia,
I'm ready.
yes, perfect. So good morning and welcome to Liberty 2 Degrees pre-close investor update ahead of the interim results for the 6-month to 30th of June 2023. Representing management, we have CEO Amelia Beattie, who will provide an update followed by questions thereafter. Please note, all guests are requested to remain muted throughout the call. To ask a question, please use the chat box or you can raise your hand and we'll unmute you. With that, I now hand over to Amelia, who will take us through the presentation. Thank you.
Thanks, Ridwan, and good morning from a chilly Johannesburg, and a warm welcome to all of you. Ridwan, thanks for hosting us this morning as I share the pre-close update for Liberty 2 Degrees ahead of the close period, which precedes our mid-year results announcement in July. I'm also joined by our executive team. Every morning in Africa, a gazelle wakes up. It knows it must run faster than the fastest lion or it will be killed. Every morning, a lion wakes up. It knows it must outrun the slowest gazelle or it will starve to death. A saying we are all familiar with. However, every morning in South Africa, a citizen wakes up, sometimes in the dark and feeling cold and hungry. The citizen knows he or she must work harder and smarter than yesterday, or he or she will not be able to put food on the table. Every morning, a resilient but weary South African wakes up. He or she doesn't know what else will happen that day or what stage of load shedding it will be. But they know, without a shadow of doubt, that a plan has to be made to do better than yesterday and find a different solution. And so it is. Going into 2023, we expected the operating context to be difficult. The most significant theme impacting current South African property returns is load shedding, without a doubt. The effects of it detract from returns due to additional spend on diesel and thereby disproportional recovery rates from tenants. Higher interest rates and persistent inflation are also hammering away at an already worn-thin economy. Overall, our operational performance continues to move in the right direction every day. Trading performance remains strong. Leasing continues to improve. There's been a good rebound in hospitality and convention activity, and our balance sheet keeps us safe in this rising interest rate environment. We continue to deliberately execute on our sustainability journey as we implement actions towards net zero, contributing to the economy and creating value for all our stakeholders in the ecosystems we are part of. We will use our strategic value drivers to illustrate where we are, starting with customer experience.
There's a guy who's at
Sorry, can we just see who is everybody online? Okay. I will continue. We will use our strategic value drivers to illustrate where we are, starting with customer.
Sorry, Amelia, I think you're mute.
Where did you lose me, Ridwan?
Customer drivers.
So I will use our strategic value drivers to illustrate where we are, starting with customer experience. Deeply understanding our customers is vital to ensure we stay ahead and in step of consumer trends. Our focus is to enhance the overall customer experience and make our properties sought after retail destinations for customers, places where people just love to be. We are guided by 3 principles, clear principles that everyone in our business understands clearly. Delighting customers through the extraordinary by offering impactful events and activations that promote dwell time and therefore increasing our spend. Deliver unique and complementary offerings and enhancing service, convenience, and efficiency. Foot count has shown steady growth quarter on quarter, improving by 8.1% for the first 4 months of 2023 in comparison to the same period last year. Can you just maybe all go on mute if possible? We have also seen a similar trend in turnover with good growth through periods of retail seasonality. Our foot count was bolstered by activations across our centers, with the most recent activation centered around the Easter period. The Easter activations were well attended, with all our centers doing an activation unique to their communities. You would have seen in the media that our Toyland activation over Christmas time at Sandton was a finalist in the International Maxi Awards. That is what we strive for. Activations with a high impact on all our metrics measured by the difference it makes for our customers, tenants, and our communities, and therefore our shareholders. The hospitality sector has experienced a good rebound in activity. The graphs reflect the current year's performance for the first 4 months compared to the same period last year, as well as the full averages of prior years. The hotels are tracking at a combined occupancy of 62% for the first 4 months, compared to the average occupancy of 59% achieved for the full 2022 period. Slightly behind 2019, still at 16, that was at 69.7. So there's still some runway to even deliver more. The improvement in occupancy also supports our convention center business. And in addition, the increase in occupancy supports our convention center business, and that was driven by higher sports and corporate bookings. The convention center events then support the hotel bookings in return. And it was a delight to witness the attendance achieved at the solar conference that we recently saw, with over 10,000 people on day 1. It shows that if you answer to people's needs, attendance are good, with spin-off revenues for parking, restaurants, and shopping, of course. A total of 67 events in the first 4 months of the year signifies a marked improvement as compared to the full year 2020 and 2021. Let's move on to tenant experience. Quarterly turnover numbers have continued to improve, with the first quarter of the year up by 7.9% compared to the same period in 2022. The highest contributing centers to the improved turnovers are Nelson Mandela Square at 21%, Sandton at nearly 11%, and Melrose Arch coming nicely back at 12%. Turnover was impacted by the closure of Zara at Sandton City for the refurbishment period. And if we exclude Zara, the Sandton City turnover grew by 14.5% for the period. Other retailers benefited from this as the shoppers were still here at the center. The Midlands turnover has been negatively impacted by the surrounding retail centers that have reopened in KZN post the rioting that happened there. From a category perspective, food services, grocery, and department stores categories showed the largest increase in rand value of turnover versus the first quarter in 2022. And it's encouraging to see that department stores, which has lagged the portfolio growth, as well as food services, which was the hardest hit by lockdown restrictions, now continue to improve. If we look at the trading density graph for the portfolio, you will see that super regionals and regional performance compared to the CLER international benchmark that was recently released. Our portfolio continues to outperform the benchmarks, with the portfolio analyzed trading density ahead of March 22 by 14.7% and also tracking ahead of CPI. Similarly, our super regional and regional centers are performing well, both achieving an average trading density growth of 18.8% and 9.2% respectively, both ahead of their benchmark. The portfolio has recovered from the impact of COVID-19 with positive trading density growth consistently achieved since the beginning of 2022. And we are happy now to move again to using trading density as a benchmark because it has a base that is stable to compare with. The categories displayed on the slide represent the top 10 categories ranked according to their contribution to the portfolio turnover. Altogether, they contributed 94% of the total turnover. The apparel category continues to lead in total turnover contribution, followed by department stores and food service. If you look at the green bars in the first column, they depict the performance rate per category since December 22. The trend in positive trading density growth has largely continued across the top 10 categories when compared to when we last reported in February for the December numbers. Food services have shown the highest increase, with coffee shops and fast foods contributing the most as subcategories in that overall category. This has been supported by consumers preferring convenient food offerings in the wake of intensified load shedding in the first 3 months of the year. Luxury brands, groceries, and health and beauty have also continued to show good growth when compared to last year. However, homeware, furniture, and interior are the categories that has detracted from the first quarter compared to December 22. People are back at the office and not homemaking as they used to be, and they're also spending more on essential items in a difficult economy. Compared to 2019, all our top categories have surpassed pre-COVID levels. No, I've said that already. Sorry, my screen has jumped here a little bit. Have surpassed pre-COVID levels, except for department stores, which are marginally below by 1.9%. As part of our various leasing initiatives, we continue to engage tenants in this category on right-sizing their boxes to extract maximum value from their spaces. The power of negotiations has shifted to a more balanced position. When you have great trading happening, it has a positive impact on reversions and negotiations at large. Retail occupancy at the end of April remained strong at 97.7%, slightly down from December at 98.1%, and that is a small pocket of space. But if we add the pre-lets back, the retail occupancy improves to 98.2%, with both these outperforming the MSC occupancy benchmark of 95%. Our two super regionals, Sandton and Eastgate, achieved occupancies of 99.3% and 94.5% respectively, and a combined occupancy of 97%. Regionals within the portfolio have achieved a combined occupancy of 97.9%, with our neighborhood center, Botshabelo, down in the Free State, achieving an occupancy rate of 98.6%. Office occupancies remain under pressure, with an occupancy of 80.7% at the end of April. There has been a slight improvement in office occupancy rates from December of 0.7%. This is going to continue to struggle along, given the challenges in the economy and the oversupply of offices. Our retail centers have remain the favorites for tenants, and they continue to attract a variety of tenants, with many exciting stores having opened, such as Sealand, Hilly Hansen, Chateau Gatto, Cafe Caton, La Parada, and Alpha Industries, which are first for some of our centers. New to mall tenants, these are tenants that have not been previously in our malls as of April 2023, currently occupy about 2,700 square meters of the total available GLA, with new food service offerings and apparel tenants really dominating. And it's lovely to see apparel coming back so strongly everywhere. It's always exciting, but a core principle of how we run our retail environments when tenants refresh their space and offering, as it displays an investment in their stores and long-term commitment to our centers. And in the case of international tenants, a long-term commitment to our country. Recently, Zara at Sandton City underwent a massive refurbishment at the beginning of 2023. As I said earlier, it impacted the turnover, with the store officially reopening on the 5th of May. The store's trade over the opening weekend, Friday to Sunday, was the highest of any store in the Southern Hemisphere. I'll say that again. The store's trade over the opening weekend for the 3 days, Friday, Saturday, Sunday, was the highest of any store in the Southern Hemisphere and within the top 20 worldwide. And that is such a proud moment for South Africa, really. It's a gift that keeps on giving. You will be delighted in the new Zara store. Go and see it. Self-checkout offerings just like you find anywhere else in the world. A special acknowledgement to our team for making sure we can bring South Africans the best that global retail has to offer. Further refurbishments across the portfolio has also picked up, with more of our tenants completely changing their look and feel to create better experiences focused on engaging with their customers. Customers are now front and center. Internationally, they talk about acquiring customers, and these brands invest so that they can do just that. Luxury brands have continued to invest in their stores, with several refurbishments underway, including Burberry and Dolce & Gabbana. The shift in consumer behavior back into physical stores in a post-COVID world emphasizes the relevance of brick-and-mortar retail, and tenants are responding to meet the shift in customer expectations towards a more experiential offering in store. Retail is not dead. Super regionals are very definitely alive. You will see these tenants also doing unique pop-ups during this time so that customers don't miss out on new trends and getting part of the new merchandise that are being released. Let's look at renewals. For the first time in a long time, a slide that I'm very happy to share with you. Leasing has progressed well this year, with over a third of the total renewals concluded in the first 4 months of the year. This includes both prior year expired leases not concluded by the end of the year, and 71% of those have now been concluded, as well as those leases expiring this year, of which 24% has been concluded. Lease agreements take longer time to agree and finalize mutually beneficial terms. This is mostly compounded by additional pressure from rise in operating cost, the rates challenge, and the balance of being able to trade all the time versus the exorbitant cost of diesel. The good news is that retail renewals are now tracking only negative 1%. Offices continue to be a drag at negative 22%. That brings the portfolio reversion for all our renewals, including both prior expired and 2023 renewals up to April, to single digits of negative 7%. The overall retail reversion is largely driven by non-turnover generating categories made up of mostly banks. If you remove this category, it improves the retail reversions from -1% to positive 0.8%. The banks have taken smaller spaces and are generally under pressure in terms of rentals. Our half-year results will present a larger base of leases concluded, but I want to caution that there are many headwinds, and although our teams do everything possible to change this to a positive reversionary position, the challenges of load shedding, rates recoveries, and higher interest rate smash hard at these negotiations. The 2023 retention rate is slightly lower, with Ster-Kinekor vacating the promenade, as we said at the end of last year, and we are considering options for the use of that space that will provide a better customer offering. We remain confident in LTD's leasing strategy, and these results show that we can look forward to sharing good progress with you at the half-year presentation. But please remember the caution that I spoke about earlier. That concludes the tenant experience, and we will just have a brief look at our debt and liquidity position. Our debt metrics remain strong and within our board mandates and covenants. The LTV remains stable at just over 24%. Our low LTV protects us in this rising interest rate environment. However, it carries the same increases, and it does impact us negatively at a distribution level. We rely on our people to execute our strategy, and they are at the heart of our business. Over the past 6 years, we have been deliberate in the transformation of our organization and transforming how and with whom we do business, given the context of the disparities of economic empowerment in our country, and particularly in the property industry. As a result of our intentional efforts in our partnerships, we are now a level 1 BBBE contributor. We have taken bold, proactive steps in our strategy, and we are proud of our contribution. This is rooted in our passion for property and a commitment to doing the right thing to effect real change. Our business is underpinned by the good that we do strategy, which is about creating value for all our stakeholders sustainably and in an integrated manner for the long term. Our malls are ecosystems that provide trading and experiential environments for our customers in the context of the communities it serves. The focus on good spaces emphasizes not only the importance of partnering with stakeholders to accelerate its positive impact on the natural environment, but by being bold in driving net zero commitments across the business operations and sites. The portfolio continues to invest in value-creating capital expenditure on projects aligned to our net zero journey. For waste management, the portfolio achieved an average diversion from landfill of close to 90% year to date by weight. Our focus on water management is on the reduction of usage through rainwater harvesting and the conversion of our existing HVAC systems from water-cooled to air-cooled systems, as that optimizes the energy use. Rainwater harvesting projects is integral to our strategy. Progress on energy projects continues, of course. We've all become experts in solar and diesel and all these things that we've never been experts in before. The Midlands 4 megawatt solar project has installed 80% of the PV panels to date, and the system commissioning is set for end of July. Phase 1 of 3 of the 4.3 megawatt Eastgate solar project is advancing well, with column enablement works for the steel support structure underway. We have also recently approved solar installations of near 1 megawatt for the Sandton precinct. The Eskom power crisis and increasing pressure on the national grid occupy a lot of our management time and focus. We have a very comprehensive plan in place to monitor early warning signs that will trigger appropriate response actions based on the incremental load shedding stages. Whilst the increasing load shedding stages are terrible for the economy and for all of us, they do keep us away from a national blackout, something we need to fight against with everything that we can. We are well engaged with our tenants and stakeholders and are adequately prepared to deal with the anticipated longer outage intervals. It will mean some discomfort, like perhaps 1 degree higher temperatures in our malls. But those are positive actions we need to see in aid of helping a bigger problem to keep the country's lights on. We are now billing tenants for diesel consumption, as we all need to together contribute to these costs. Each and every one of us have a responsibility as a citizen of this country to do our part in understanding what we can do as individuals, as a collective, and as businesses to minimize and learn when to switch off things, small and big, so that we can keep this grid on. Our team, through the Sandton SID, has been spearheading the traffic lights initiatives in Sandton and will also bring more intersections onto our power supplies. However, we have to hold our authorities accountable for doing what we pay our rates for. The burden of keeping the services working can't be pushed onto business at every angle. We all have our part to play. In closing, our portfolio continues to produce good operational performance despite a difficult environment. We are deeply committed to delivering value for all our stakeholders. However, a combination of the persistent power crisis, low economic growth, ongoing and above inflationary hikes in municipal costs, and increasing interest rates represent unrelenting headwinds for our tenants, our customers, our service providers, our people, and our business. Notwithstanding this, continuing to drive more cost efficiencies, operational excellence, and leasing improvements are key enablers to achieving this year's outcomes. We maintain our distribution guidance of 0 to 8% DPS, but caution that significant uncertainty could impact that at any stage. Giving up is not an option. We get up every day like a gazelle or a lion, you pick, and do what we need to do. We have a portfolio that illustrates its quality and strength every day. That brings me to the end of the pre-close presentation. We will take some questions, and we also have our AGM later this morning at 11 o'clock, and we would like to thank you for your support. It really means a lot to us. It keeps us going, and we look forward to seeing you again when we do our half-year presentation in July. Ritwan, I'll hand over back to you.
Perfect. Thank you, Amelia. We do have some questions coming through, but just a reminder, if you'd like to ask a question, please use the chat box or raise your hand. So the first question has been answered. When is the Zara refurb completed? The second question coming through was, given tech can be classified as discretionary spend and only up about 0.4% since December, are you seeing a consumer that is under pressure, therefore impacting trading density in the short term?
I think the consumer is definitely under pressure. We know that. It's written about every single day. We believe that we scoop and attract a bigger portion of the pie with the offerings that we have. So the overall basket is the same. The consumer just choose to come and spend it in our malls because they get more and better experiences here.
Perfect. The next question is coming from Louis. On the first slide, you have tenant turnovers of up 7.8% year on year. This does not seem to agree with the category performances, which are mostly above that level. Can you just maybe clarify those figures, please?
The figures are correct. You must remember some are up and some are down. So that 7.9% is an average number. And it is the overall aggregation of all the turnovers. It is important to understand that not every single tenant are trading up. There are tenants that are struggling, and that is just the way it works. So 7.9% is the average, and then the categories that we are showing are the ones that are performing well.
Perfect. Next question from Luando. What percentage of GLA is department stores now this year at L2D compared with 2019? Oh, that's
I don't think we had a significant change in department store exposure. And we will give those details in our mid-year presentation. I think, does it make around 25% or more or less? But there hasn't been a significant change.
And then the next question would be a follow-up on the grocery and supermarket. There's a sense of GLA change since 2019, if you have that number.
There has been no change in GLA. Our supermarkets and has stayed more or less the same. Might be a small change here or there, but at large, there has not been any significant change.
The next question from Pranita. Can you give us an idea of what the diesel cost incurred year to date has been, and what the recovery rate has also been in the first half? And then maybe I can add to it, what are your projections given stage 6 becoming the new norm? What are Liberty 2 Degrees projecting for the remainder of the year?
We are bringing out our half-year results at the end of July. We will do a full analysis of the diesel spent to date, the costs, the recoveries, everything that goes with that. We are not providing it at the moment because it's mid-cycle. And all I can tell you is that the focus on it in our business are very intense and very focused. We make sure we do the best that we can in terms of that. Remember that our centers remain on all the time and that tenants are able to continue to trade. But if you recall what I said earlier, we, for every stage of load shedding, have actions that we implement to minimize the spend, and we will continue to do so, so that we can provide good customer experience on the one hand and tenant trading environment, but keep the costs where we can possibly keep it. Some of this is out of our hands when we have 10, 12 hours of load shedding a day in some areas, but we'll continue to manage it very, very closely.
The next questions are coming from Fayad. What has the occupancy cost ratio done since December?
We will do a full analysis of our occupancy cost in our July presentation. But if you listen to the renewal rates, and then on the other hand, the cost increases, this remain much of a muchness. There's not been a significant change. Last year, you would have remembered that it's come down to a more sustainable rate, and we work very hard on understanding those ratios deeply. And I remind everyone that this is not rent to sales ratio. We prefer not to use that metric because it doesn't take the full costs into account, and we understand what goes into a tenant's cost and manage that effectively down, aligned with our leasing strategy.
The question on diesel cost has been addressed. The next question, still from Fayad. Has the Woolworths lease renewal at Sandton City been concluded?
It has been.
I guess an update will be given at interims.
We need to sign the final agreements, but the agreements has been, everything has been agreed by both boards, and we will give an update on that during the July presentation.
Sure. Is there an update on the rates appeal process?
We are still engaging in the appeal process and considering our options. It is very complex. And also at an industry level, there's a process going on to understand what can be done in terms of the Act, in terms of how, both the valuation principles as well as the rates can be addressed. Everyone's focused on this, and there's a lot of work going on in it, but there is no outcome as yet, and we will update as soon as there is anything.
Thanks. Next question coming from Peter. Are there any debt refinancing requirements in the next 12 to 24 months? Does Liberty 2 Degrees plan to look at a bond program in future?
We have 500 million coming up. I think it must be in October. And the teams will work on that, and we normally have a lot of appetite for that. Jose took a lot of time to explain in previous presentations that the size of our debt does not make bond programs viable from a cost point of view, but we always investigate it and see at every juncture if there is something that makes sense.
The next question coming from Rashad. Can you provide some color on retail renewals completed during the period? Which tenants and where? And maybe what has the experience been with department stores and apparel tenants who are the largest portion of retail renewals for FY23?
If you go back to that slide that we had on it, so most of the renewals have been banks or non-turnover generating tenants, which have been slightly down, and lifted up by apparel renewals, which has been up because they had a good trading experience. And again, I'm talking about the overall average. Some were up a lot, some were down, but we have seen a positive trajectory in apparel, and there has not been a big department store renewal in the period. It's coming, and we will see where we're tracking with that. That's why it's also encouraging to see that department stores from a trading point of view has been trading up, because that creates the environment in which you negotiate that renewal.
Perfect. The next question coming through. Please, can you provide more detail on the Zara refurb regarding yields?
We don't disclose individual tenant negotiations and what it does. What we do make sure is that we bring to market a product that is superior to what is anywhere. Zara spent a significant amount of money in that store, and the store was also significantly larger. So we use storerooms, previous storerooms, to now create retail space. That in itself can tell you what it has done overall. Go and see that store for yourself, and you will see that it is something really, you get the same experience as you get in New Bond Street. In fact, I'll argue that you get a better experience as in New Bond Street in London, and that is good for the center overall. Good trading, and we'll see some positive impact from that.
Don't just see, they need to also support trading densities.
Yes.
What are the easy wins for management in the short term?
There are no easy wins in this environment. It's been a long, hard slog every day, getting up and making sure we do the things that we need to do. We have not left behind anything in our strategy. We continue to work on our sustainability strategy in this difficult times. We focus on doing the basics. We focus on getting the right billings out. We focus on leasing. We focus on the things that make a difference to the long-term sustainability of our business. We can't just focus on little things to create short-term blips in our growth. we need to bring the property industry's businesses back on track to create long-term returns. Of course, we have small wins that we celebrate every day, and they all together, like diesel recoveries, new tenants, interesting events that we have that bring more people. Those are all things that we do every day. But easy, it's not been easy.
And hospitality, how is the hospitality sector performing relative to budget? Can you provide more insight into that side of the business?
The hospitality sector has really been doing well, and it has been performing well against budget. It had some strong months and some months that have been on budget. And we continue now that the Sandton Towers are fully open. We see the benefit of that. We really see good benefit from the convention center events. There's been a lot of events. I said before, if we can't get into our parking at the office, we know that our hotels, convention centers, and tenants are benefiting because there's a lot of people around, and we'll see good performance from this at half year from this sector.
Next question coming from Ines. Is the company undertaking share buybacks?
As we communicated previously, we allocate our capital very carefully. We've got some initiatives that we are working on that requires capital, and these are mainly our energy and solar providing initiatives. It gives us good returns, and it's the best use of our capital at the moment.
The potential for the potential rate hikes that we could see, 25 basis points, 50 basis points potentially this week. How does that impact Liberty 2 Degrees given your 80% hedge ratio? And maybe just provide some insight into strategy regarding being hedged at 80%. Do you look to increase it now? Maybe just give some information on that.
Our board-approved strategy is to be hedged over 75%, and we are comfortable with where our hedges are at the moment. As I said earlier, we have a low LTV, so it impacts us less than it impacts everyone else, but the rate impacts us in the same way that we have explained in our when we did the presentation on our hedge ratios and debt earlier in the year. As I said, there's 500 million coming up later in the year, and that will probably we'll have to see what happens with the rate and what is priced in at that point in time.
A follow-up question coming from Nazim. What is the capex cost for the refurb at Zara? How much did Liberty 2 Degrees contribute versus tenants? And how does this compare to the initial capex when it entered Sandton City? Just want to get a sense of how often they will have a capex cycle for major refurbs.
Tenants make their own decisions as when they do these refurbs. We have some commitments from them in their leases as to what they need to do. We aim to bring the best product to market. We do not disclose individual tenant agreements. By agreement with them as well, we are bound by lease agreements in terms of that, and it's a good product. They have spent good money on it, and we are happy with what we are getting out of it overall. It's been a good thing to happen for Sandton City.
The next question, in your FY22 presentation, you talked about capital allocation. Please, can you just provide an update on that?
As I said in the earlier question, we focus our capital allocation mainly on our energy and HVAC projects, and that is all on track. And we have been executing very hard on those to make sure that we can bring our costs down in the long term.
The next question coming from Chris. Are you finding any attractive acquisition opportunities? And then maybe to go with that, given the current migration on the go to Cape Town, what is the team's view on gaining more exposure to that region?
It goes back to our question around capital allocation. We need to focus our capital at the moment on these energy providing initiatives. As we said in previous presentations, it is better to invest in solar energy than in a new shopping center. And that is what our focus is at the moment. We are watching the Cape Town move and semigration, or not just Cape Town, also the garden route with interest. Also watching with interest how some people are returning, because it's hard to commute up and down every week, and families are impacted by that. So we'll stay close to it. We always are presented with opportunities. We look at those opportunities and we weigh them up in terms of the overall capital availability, and also keeping in mind the cost of debt versus the returns that we get on assets that are available in the market.
Perfect. Seems you've answered all the
Gosh,
questions,
you don't give me a
Amelia.
break today, do you?
Yeah, it's not me. It's coming through from the guys, so I'm guessing it's a good thing. Seems we don't have any other questions, Amelia. Give it a minute. If nothing comes through, then I hand over to you for closing comments.
Great. Thank you very much, everyone. Thank you for your active engagement. We love engaging with all of you, I promise. And that we're not seeing you in person this time. We'll see you in person at our, hopefully at our mid-year results when we come around to visit. We'll have our AGM coming up shortly. Some of you will be there. And once again, thank you for your support. Thank you for being here this morning, and stay well.
Perfect. Thank you so much, Amelia. Thanks for allowing Nedbank to host this call, and thanks to everybody for joining. Enjoy the rest of your day. Goodbye.